Along with high-frequency trading, the rise of dark pools is among the most controversial topics on market structure at the moment. The controversy arises from the fact that an increasing number of smaller orders are now being routed away from the traditional markets to markets that are fundamentally less transparent on the rules of access and price formation, which gives rise to the term dark trading. While the argument in favour of dark markets is that they enable smaller clients to jump the queue and in some cases achieve price improvement, concern has been raised that the level of price improvement was not sufficient to compensate for the higher spreads and poorer reference prices that result as dark venues grow. Convinced by these concerns, the Australian regulator introduced a new regulation on 26 May 2013 requiring meaningful price improvement before an order could be routed to a dark venue. This change mandated that trades must either provide a full tick of price improvement or, when a stock is trading at the minimum tick, the midpoint price. Using the market quality dashboard, we analysed the impact of this new rule on observable dark and lit markets in the wake of the change. Begin our analysis by selecting the Local Venues tab, clicking on the Add Venue button and choosing each of the 4 observable venues available, namely the ASX and Chi-X and their respective dark pools. We select the 6-month time frame centred on the date of the change and choose the first metric for review, namely on-market share percentage. Selecting the Show Events checkbox and ticking on the ASX market allows us to identify all market design changes to have occurred over the relevant 3-month period. 6 months, I beg your pardon. Ticking on Event Box 13 takes us to a more detailed description of the rule change. Moving back to the on-market volume share metric, note the instantaneous drop in the ASX dark pool market share, coincident with a rise in the lit ASX market share. Indeed, it is apparent that these changes started occurring in the week before the rule became mandatory. One suspects to ensure no inadvertent contravention of the rule. Deselecting the 2 ASX venues, we can see a similar drop in Chi-X dark pool venues, though not quite as obvious. The clear winner from the change was the ASX lit market. Their combined market share of 80% before the change seems to have moved to 85% in the wake of the change. Looking now at the variable scope, which measures the number of firms traded on a venue relative to the tradable universe, we can see that the ASX dark pool in black reduces the number of companies traded by approximately 1/2 around the rule change. This suggests that brokers simply turned off dark trading for many securities, likely the less liquid securities, where 1 tick in price improvement was going to be far too good a deal for their clients. Using relative effective spread as a proxy for market efficiency, by turning off the dark pools, one can see that the change had very little impact on the main markets. Turning off the main markets and turning on the dark markets, we can see a major drop in the ASX spread, which has previously been 50% above Chi-X, moving into line with Chi-X in fact. This likely results from the removal of the smaller stocks, which one can expect to have had wider spreads. Recall from the market quality framework, transactions costs are but one element of market efficiency, price discovery being the other. As this metric is not currently available in the local venues area, we revert to the global venues tag and choose the ASX market and the relevant time period again, along with a proxy for price discovery, namely intraday volatility. While we can see initial change, post the rule change, 3 months on from the change, there appears to be no lasting change in the level of intraday volatility. A positive change in transactions cost with no change in price discovery leads us to the conclusion that the rule has had a positive impact upon market efficiency. Turning now to the other element of market quality, namely market fairness, we need to look at the impact of the rule change on insider trading, market manipulation and broker-client conflict. We choose information leakage as a proxy for insider trading and dislocation of the end-of-day price as a proxy for market manipulation. Both the latter 2 metrics show no perceptible change around the introduction of the rule. No change in fairness, but a positive change in efficiency suggests that the introduction of the minimum price improvement regulation has improved the quality of executions in dark venues in Australia without harming the efficiency or fairness of the lit markets.